Right now, I'm going to do a little money management. Charles is going to come up and do some money management. Then we're going to go through and do some animations that are a lot of fun. Then we'll get into the general market. Why don't we turn to page 504. Now, how many people here have less than 8 stocks in their portfolio? Okay, good. So you can see on the list here about where we should be. And this is how Bill feels strongly about concentrating your portfolio and staying within here. If you have a very large portfolio, much larger than this, there are some exceptions where you might want to go with a few more. But if you concentrate between 5 to 8 stocks and you get your diversification by industry group, you're really lowering your risk, because to be able to watch 5 to 8 different stocks, you're going to be able to get to know them, and you're not going to really get caught off guard by things. So a lot of times people think this is, very risky being this concentrated. And it is very risky. If you have 8 stocks that are reporting in earnings in 1 week, that's a lot of risk to take. If you're trading 8 stocks that are all semiconductors, that's really risky. So there's a lot of ways to diversify yourself within 5 to 8 stocks. So as we talked about earlier, you want to have like one category that's your risk category. So the IPO base would be your risk category. So if you are trading one of those, the rest of your stock should be more normal, and you might want to have one slow and pokey type of stock in there to kind of balance out your portfolio. Now, everyone is going to trade a little bit different, so some people are going to be able to handle a little more volatility than others. So when you're trading thin stocks, that's just like trading an IPO stock. So anything really trading maybe 300,000 or 500,000 shares or less could be considered thin. Around the office, sometimes we'll be trading stocks that trade more than that. They act thin, so we call them thin traders, because you're getting in and getting out of them. Even though they trade more shares, you're kind of pushing the stock around a little bit. So you should be watching your orders when you put your orders in and see if you're having much movement, if you're adding a lot of movement to the stock. So everyone's going to be different. If you're buying, 1,000 shares or something, it shouldn't be a problem. But if you're buying in any large size, you want to be aware. If you're moving the stock around, that's just adding some more risk. And so you're going to have to tone down your portfolio somewhere else. Now, how many people here trade on margin? Okay. So if you don't trade on margin, there's nothing wrong with that. If you do want to start venturing out and trading on margin, you want to start off slowly. You don't want to go full margin. By full margin, I mean if you have $100,000 to invest, $100,000 worth of cash, full margin would be $200,000 invested. Well, if you've been trading on a cash basis only, you're going to be used to a certain amount of volatility. Some people look at it with percentage swings, which I think is the proper way to look. You're up or down 1% or 2% in any given day. Other people look at it with dollar amounts. They say, I'm up $10,000, I'm down $10,000, or I'm up $100,000, down $100,000, or $500,000. Whatever the amount is, if you start thinking in dollar terms, is going to impact your trading a little bit more. So try to think of things in percentage. So if you're not trading on margin and you're used to a volatility of, let's say, 1%, you start trading on full margin, you're going to have volatility of 2%. So start it slow. Maybe the first quarter or half a year that you're trading on margin, just go 10% on margin, just a little bit, and then gradually get used to the feeling of the extra volatility and see if it's helping your trading or hurting your trading. Some people do better with a cash account. I know a portfolio manager who has a cash account who's done extremely well with it, and I think probably not being on margin is helping them. So you don't have to trade on margin to make big money. We do trade on margin at the firm during bull markets, but we also back out really quickly. So if you are new to this, meaning you've been trading our style less than a couple years, I would not trade on margin. You're just still too new. You haven't been kicked around enough. I just don't think it's prudent. You can make plenty of money and lose plenty of money just trading on a cash basis. The margin will just kind of get you there quicker, up or down. So once you've really been doing it for a while, you know that you can trust yourself with your losses or following the rules, then feel free to go a little bit on margin. But if you ever get caught off guard and you just can't cut your loss at 7 or 8%, then you need to be backing away and resolving all those earlier issues first. So going into more of the mechanics of it, And we touched on this earlier. If you've got $1,000 or $1 million portfolio and you're trading 8 stocks, you break that up evenly. And this is what Bill feels strongly about, is if you start off each stock with the same amount, you're going to be better off because you never know what that next big winner is going to be. You don't know what the next Apple or EMC or Home Depot is going to be at the beginning of the move. You might think you know, but you don't really know. And Bill doesn't even know. And that's what he'll tell you, is that he doesn't want to get caught off guard by having a tiny position in his best name. So by starting off with the same amount in each stock, you kind of solve that problem, assuming that liquidity is not an issue. So when you first buy a stock, you don't buy your full position. You buy half your position. It goes up a little bit. You buy another 30%. It goes up a little bit more. You buy your last 20%. This should be absolutely automatic. You don't even think about it. When you are getting ready for your next trading day, when you have your little shopping list together of the stocks that you're going to buy, the 2 or 3 stocks that you might buy, you should write down, I'm going to buy it at $50, and I'm going to follow up at $51 or $52, and so on. So as the stock is doing it, you're not sitting there calculating it out.
How about if the first increase is the same day that you buy the first time? If it goes up another 2% that you buy that day?
The best positions are typically the ones where you get your full position the same day, typically within a very short period of time. Just think about it. We've got the people in the room that are trading the system. We've got people all over the country. We've got big hedge funds that are following the system now too. So everyone's looking at pretty much the same stocks, and they're trying to buy it at the same time. So when that stock goes through there's all these market orders, and so everyone's buying it. Plus, it's the natural place as a stock is going through a pivot. So the best ones are going to go up at least 5% on that breakout day. So that's why you've got to be there on top of it and ready. That's a fair question. All right, so here is kind of the breakdown of trading on margin. And I really don't want anyone to feel pressured at all into trading on margin. You should, once you are ready for margin, you'll kind of know that, okay, I'm used to this, I've learned my lessons, I've done a post-analysis, I feel comfortable with this, I can take on a little bit more risk, then go there. If you're leery at all about trading on margin, then you're going to do poorly. Even if you might be ready technically, mentally, you're just not ready yet. So treat this with a lot of respect, because margin can be your best friend or your worst enemy. So here's just kind of how it breaks down so you can see a reference. All right, now follow-up buying. This is getting into the pyramiding. So now we're out of the starting gate, and you've bought your stock at your pivot. Now what do? There's a couple different ways to handle it. You can just hold on to it, and once it's up 20%, you can just take your profit and move on. How many people trade that way? They just buy the stock. If it goes up 20%, they sell it. Okay. There's absolutely nothing wrong with trading that way. And some people's their personality is just built that they just kind of want to lock it in and move on. Other people want to pyramid and focus on the stocks that they really know and is making money for them, so they're trying to get more assets in there. That's what Bill does. That's what Charles and I do. And so I'm going to walk you through how you do that. If you're in a stock and you're somehow able to sit through another base and it breaks out, then you're going to be buying a lot more shares there. I'm sure Charles probably talked about sitting through bases, and it's not an easy thing to do at all. If the stock pulls back into a 10-week moving average, you can add there. And if a stock goes 3 weeks tight, you can be adding there. So I'm going to walk you through an example here. So we can turn to page 506 in your book. And we're going to look at Ascend. Now, this is a very extreme example. I don't want you to walk away thinking that all stocks that you buy are going to do this, because they really aren't. I wish it was this easy. But what you're doing right now, you can just kind of equate it to going to the driving range if you're a golfer. You're just practicing. And so what we're going to do is we're going to walk through as the stock goes up and seeing where you would be adding shares to it if you did want to pyramid. And you should be doing this at home. Take your model books and look at moves and say, okay, if I were to pyramid, where would I buy and how much would I buy along the way? So the first thing you need to do is determine where's your starting point and where's your ending point. By starting point, I mean how much are you going to put in the stock to begin with. So let's say it's 15%. You have to have an end limit. As you're pyramiding, at what point are you going to stop pyramiding and say, I have enough stock, enough of this one stock? Bill, over the years, has just kept on buying and kept on buying, and he's ended up with 200% long in one stock several times, and he's been able to get away with it. We've done 100% or so in one stock a couple years back, and it was just, we got away with it with Apple and Google back in the heyday, but it was just too much volatility, and I just don't find that it's a sound way to trade for the long term. But somehow he's been able to do it and get away with it. So you have to have a ceiling. I'll tell you my ceiling in a moment, but how many people have an absolute ceiling they won't go more than X% in one stock? You can't pyramid until you know that number. Everything that I'm going to go over now, don't do any of this at home until you figure out what that number is, or you are just going to blow up your account because you're just going to keep on buying and buying and buying, and it won't be pretty. So you have to find out what that number is. My number is 30%. I won't have more than 30% in any one stock. And that'll change. About a year ago, it was 25%. Now it's 30%. A few years ago, it was 100%. How do you find out what that number is? You need to do a post-analysis. This is going to be some hard work for you. So you're going to go back, you're going to go over your trades, you're going to see where did you start making mistakes because you had too much money in one stock. And you have to be very honest with yourself. I think Charles probably mentioned, keeping a journal for trading. If you keep a journal, this would be much easier for you. But if you don't, you're going to have to go back and you're going to have to look at your trades and say, okay, I blew Apple because I had too much of it and I was shaken out. Or you were shaken out of whatever the stock is, and then go back and see what percent of your equity that was, and you know that that's too much. The only way to do it is really a trial and error. And I can tell you the percent will be determined based on, your experience in the market plus your experiences in the market. So as you go through, you're going to say, okay, well, once I have 40% in one stock, I just feel very uncomfortable. I feel very edgy because I would realize the risk. And then, okay, I can't go to 40%. So I can't go to 40% anymore because I know I'm not going to handle the stock right. 25, 30% I can handle. So you have to just kind of be honest with yourself, look at your account, look at the volatility, and that's the most important thing. If you don't do anything else when you go home, that's what you should be doing. Or just buy a stock at a breakout, sell it when it's up 20%, and just be happy. There's nothing wrong with that. But if you want to do any of this, you have to figure out that number. Very, very critical. So we're going to say, with this exercise, we're starting off with 15%, and our maximum position is going to be 30%. So we buy our 15%, assuming it's all in this, this one day, goes, we buy 50%, 30%, 20%. That equals 15% of our account. And now it has this little shakeout, and it recovers from that, so you can add some shares there. Now that is not a major adding point. So you might add 0.5% or 1%, so your 15% is now maybe 15.5% or 16%, but it's not a major place to add. And this really becomes an art, and it really depends on a lot of things: how you're doing for the year, where you are in the general market, what type of stock you're trading, how quickly do you want to get to that maximum position of 30%, or whatever that number is for you. That will determine how many shares you buy. But you can see right away, if your starting point is 15% and you don't know what your end point is, you have absolutely no way of figuring out how much you should buy there. So I would say maybe 0.5% or 1%. Now it goes up and it builds 3 weeks tight. Now this is more of a proper type of entry point, so I might add a few more percent there. We're always adding as the stock is going up, so we're not averaging down. If the stock were to come down, we're not going to be adding anymore. But it doesn't mean that each buy has to be less than your last buy, size-wise. That's important. A lot of people don't get that. We're building a pyramid. You're starting off with your major 15% down here, and all of these just have to be less than that 15%. But they can be varying amounts depending on how solid that buy point is. So you're adding maybe a couple percent there. I'll show it to you on a daily chart in a moment. And then you've got a couple of pullbacks to the 10-week line. And that's probably one of your safest buys. The first couple pullbacks to the 10-week line, especially out of an initial base, that's about as good as it's going to get for a secondary entry point. So that's where you would be buying a lot more. And it really just all depends on how fast you want to get up to your maximum 30%, and then you just have to leave it alone. So let's look at that on a daily. Here was our breakout. We initiate our position. It has a little shakeout, recovers, so you can add some shares there. Now here's 3 weeks tight. We have, I think, a better example in a little bit of 3 weeks tight, and I'll show you how to get into that. Now, these are your pullbacks to the 10-week line. You have to ask yourself how it is that you're going to buy them as they come in to the 10-week line. So how many people like buying them as they're coming in and coming down to the 50-day? Okay, how many people like buying it as it's recovering from the 50-day? Okay, if you're not sure which side you're on, that's fine. You want to start trying it a few times with a small amount and seeing where do you feel more comfortable. So for example, Charles would be buying it as it's coming in. He might be buying it, on this day near the lows of the day. I'm thinking that he's going to kind of be soaking up shares over here. And that's fine because he's comfortable if it's dead money for a few days. I don't feel comfortable that way. I like buying it and seeing the stock immediately go up. So I'm going to have a higher average cost. I'm going to have to pay up more. So I'm probably going to wait for this to go through some area of resistance. So on this day here, I'm probably waiting for it to clear the high of this day or maybe this day, so I know that I can expect this. So just be really honest with yourself. There's not a right way or a wrong way. It's how do you feel the most comfortable. Because the more comfortable you feel, the better off you are and the better you're going to be able to handle the position. So if you're very sensitive to your cost basis, you want to buy them lower. If you're more sensitive to the stock proving that you're right away, then you're going to be buying it as it recovers. Same thing here. Charles would probably be buying it some on this day, and some more on this day. So he's got a very good average cost. I'm probably waiting on this day. It reversed, closed near the highs. I might buy some there, and I buy some more on that day.
When you say you're buying, are you adding like 1 or 2%?
Yeah. So let's say we bought 15% over here, maybe about 0.5%, or just nibbled over here, maybe 1% over here. And then the 3 weeks tight, because it wasn't a standard 3 weeks tight, maybe we bought 2 or 3%. So we've got, let's say, 18% in it. The stock is showing that it's got a lot of power. We know it's an initial base. The relative strength line is screaming, and it's acting completely normal. This is a very normal action. When a stock goes from $17 up to $27, you expect it to come in. And since it's doing everything right, you're more willing to put a little bit more in. So maybe even 3 or 4% on each one of these. Now, if it handled itself in a different way, the answer would be different. Maybe it would be 1% or 2%. So it depends on how much risk you're assuming and, once again, how fast you're trying to get to that 30%. Now, if you do your homework and you find out that you only feel comfortable with a 20% max, which there's nothing wrong with that. I've had years when that's what I felt comfortable with. Then you might start off with 10% instead of 15%, and these buys would be a little bit less. So it's all relative to those two numbers. That's why I said it's very, very important. If you're going to do this, you've got to know where that starting point is, which is the same amount on every stock, and you have to know where that ending point is. I'm just curious. I don't want to put you on the spot. You were one of the few people who answered. What is your percent? Yeah. 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 How much? 10%. Okay. And there was somebody over here that had it too. Yours is 10%? Okay. And was it you? 20, 25. If a stock grows, let's say it's 30% is my maximum or 10% is your maximum, there's not a wrong answer here. And once it starts swelling from there because of the performance of the stock is outperforming your portfolio, I just leave it alone. So, if I've got a position that's 31 or 32% because it's grown faster than the rest of my portfolio, I just leave it alone. So I think that's like what happened with you. So you had a big winner and it became, a big part of your portfolio. That's a good problem to have. Good for you. Sure.
It goes from almost 28 to 20, so that's like a 35% correction, and the RX line is also into a new low. You still would be buying them?
She's asking about, she feels that this is a very severe pullback. From 27 to 20 is a severe pullback, but you have to look at the context of what's going on. This is a recent new issue, so it's going to be more volatile, and it's had a powerful move where it's gone from $16 to $27 in a very short period of time. So it's always entitled to give back a third to a half of the move. That's very normal in stocks for a stock to run up and then retrace about a third to a half. Sometimes more, but whenever you look at a move, kind of look at a 50% retracement or so and say, okay, this is probably where the stock could get to. And whenever I'm trading a stock, I'm always thinking, this stock could pull into the 50-day at any point, and how am I going to handle that? So that's your floor. So the further a stock gets away from the 50-day, the more risk you're taking. No, this RS line the question is about the RS line, does it bother me? This RS line is absolutely beautiful. It's picture perfect, so that's a good thing that you're picking up on. Don't pay attention to the little wiggles in it. You want to look at the general trend of it. If this started going flat over here as that was recovering, that would bother me. Moving back to a weekly chart. So now you can see here is our first buy, then with the 3 weeks tight, a couple pullbacks to the 10-week line. Now it forms a couple base structures. So one of the first charts we looked at this morning had bases that looked identical, like it was the General Electric and the Tennessee Coal bases that looked like the same character of the original one. And don't these look very similar to this first one? If you look at it, you can say, okay, that's giving you some conviction that the general feel to it is very similar. It's short and kind of deep. Short and kind of deep, and short and kind of deep. So we know that the trend is intact, it's going almost straight up, and the character is intact. So it's doing everything that you would expect it to do. So that's giving you that conviction to try to get to that 30% or 10% or 50, whatever the number is, as quickly as possible. So you have a couple of perfect buy points here, another base, and this is probably one of the only bases that, is realistic to sit through because you've had a gain so quickly. So remember, if a stock goes up 20% within 3 weeks, what do you have to do? Hold for 8. That's a cardinal rule. You hold it for 8 weeks, so you're out 1, 2, 3, 4, 5, 6, 7, 8. So you know that you're still in the stock up here because you haven't sold any. So since you have such a huge gain, you're able to sit through that base without too much trouble. And now, as it breaks out of that cup with handle, you're going to be adding a fair amount right there and a fair amount right here. So the likelihood, if you bought this stock and you weren't shaken out of anything, that you would probably have your full position at this point. Okay, that's the way that you should kind of, approach this stock, this exercise. So this is an exercise that you do on lots of stocks, slow, pokey type stocks and stocks that go like this. But you also want to do it on stocks that fail, because you want to see a stock that gets you sucked into a 30% position and then rolls over. You're going to have that happen to you, and you want to know how to handle it. Pyramiding is what I'm talking about, of buying here and here and here and here, meaning you can buy different amounts as you're pyramiding up. So you bought, let's just call it 15,000, just to make it easy. 15,000 shares here, 1,000 or 500 shares here, 2,000 shares here, 3,000 or 4,000 shares here, maybe 5,000 shares here, until you've reached your 30%. That's pyramiding, and as long as all those follow-on buys aren't more than your original basis, that 15,000, you're fine because you're building a pyramid. The initial buy where we go 50, 30, 20, that's not really a pyramid. We say it's pyramiding because it's just easier to explain to people. That's your initial position, 50, 30, 20. So your original position of 15%, like we're using in this example, I just look at that as here you bought 15%, but really you bought that in 3 chunks, 50%, 30%, 20%. Percent of your equity. We always do things as percent of equity. So that's how I look at it. Some people on the team might look at it as dollars or shares or whatever, but I'm always following my sheet and I'm looking and saying, okay, I'm 15% and I'm trying to get this up to 18%. And then I just back into whatever the numbers are, dollars are. Okay, so now we're up even further. If all our stocks did this, we'd be very, very happy. But it's just realistically not going to happen. So it's moving up, and you're up here. If you still had some room in your portfolio, you could add to it up here. You're really kind of asking for it. But we just wanted to point out the different places. So It's a pullback to the 10-week line, 3 weeks tight, another pullback, another pullback. And these are the things that you should be marking on your chart. And that's what we do in-house. We do that all the time, and this is just our practice work. And here it is on a daily. So you can see our original buy, all those points. It makes it look really easy once it's like this, right? Another 3 weeks tight. So on the 3 weeks tight, here was a better example of that. As you're buying this, once you recognize that a stock has done 3 weeks tight and you recognize that on a weekly chart, you're free to kind of buy it at any point. I like to wait until it goes through an area of resistance, an area like this. That makes sense to me. Charles might be buying it, or some of you might be buying it down in here, and there's nothing wrong with that. So how many people buy their 3 weeks tight while it's still in the 3-week consolidation? Okay. How many people wait for it to go into new high ground? Okay. There's probably some of you who just aren't sure yet, and that's fine. All right, so now it's gone up even further, and eventually, you really can't be adding, but it was just showing the different areas where you could add if you had a death wish or something. I mean, look at that. It's scary how far a stock can go up. And there it is, he eventually tops. So here's your motivation for going home and studying and figuring out what your maximum position is. One of these days, you're going to get a stock like this. And you've probably traded stocks like this, but you've been in and out of them. But if you can get one of these stocks, it'll have a meaningful impact. It could change your life. You string 2 or 3 of these together with a decent sized position, and it will have a very big impact. There it is on a daily. So here is, I keep saying that this is how we do it in-house. This was taken out of a model book, and this is Bill's model book. So we included it in your workbook. This is his markings that he has on there. And if you notice, there's lots of cool stuff on here. Look at that. There's that downtrend alternative pivot that we talked about earlier. Here's a little code, SUFB. What do you think that stands for? Straight up from the bottom. Yeah. The bad stuff is in red. The good stuff is in blue. So what I would suggest you do is stop looking at this chart. The next chart is the exact same chart, the same time frame. And when you have some time one day, sit down and mark up the blank chart that you have as much as possible. Everything, all the places where you would buy it, all the different things that you see on there. And then go back and check Bill's notes and see what things that you picked up that he picked up, or maybe you picked up some things that he didn't pick up. So I think that'll be a lot of fun for you to do if you're a stock junkie like me. So hopefully that'll be a fun exercise for a couple hours.
All right, so let's move into different styles of trading, because they're all a little bit different, and there is room in our system for different personalities. How you approach the market will in large part depend on your own personality and your own psychological makeup. Now, I consider myself more of a singles hitter. My approach has always been to trade very actively, lock in my profits along the way, and compound my account as quickly as I can. So in any given year, I'm going to make thousands of trades, easily over 1 or even 2,000 trades. And that's a lot of trading. Now, would I prefer to buy 1 or 2 big winning stocks and just sit with them and make a killing? Well, of course I would. But that's a lot harder than it sounds. So my personality is really very consistent and in sync with my trading style. For me, the pain of giving back my hard-earned gains is probably just a little bit worse than the pain of missing out on a bigger move. Now, I hate it when I have a stock that I sell, I think it's going to pull back, and it keeps going up. I hate that feeling. It's a horrible feeling. But I also hate it when I round trip a stock, when I have a solid profit over a fairly short period of time, and I give it all back, giving back my profits and wasting time in the trade. I have a confession. In all my years of trading, I've never had a long-term capital gain, ever. And I'd love to have one. My taxes are ridiculous, but I've never had one. And yet, over the last 10 years, I've had really great, consistent performance almost beating the market just about every single year by a very wide margin. So over the past 10 years, since 2000, the indices are down. The Dow, the S&P, the NASDAQ, they're all down over a 10-year period. My account's up over 1,000%. I have a personal account that's up over closer to 2,000%. It's not even a margin account. So this is a 10-year period where we've had tremendous volatility. We've had 2 of the 3 worst bear markets in a century. But overall, if you just bought and held, say, a mutual fund, you'd be even or down. So it's really been an extraordinary period of time where if you're doing it right, you can make substantial progress. And if you're not, you haven't gotten anywhere. It's just a very interesting period. Mike has had similar performance. He's had really tremendous performance as well over the same period of time. And yet the interesting thing is that Mike and I are wired completely differently. Whereas I am more comfortable buying stocks on weakness, on pullbacks, he kind of mentioned that in his last session here, and selling on strength, he is more comfortable buying strength, and he'll usually wait until stock is actually breaking down before he sells. So I'm buying weakness, selling strength. He's buying strength, selling weakness. And at the end of the day, we both had really great performance. So the point is that there's more than one way to do it and be successful.
Of the 1,000 plus trades you make in a year, how many positions does that equate to? I'm sure you've got multiple trades.
I trade the same stocks again and again. I'm going to cover kind of my technique right now, actually. It could be as many as 50 or 75 stocks, maybe. Usually what I found, though, is it's usually still a small number of stocks where I make my big money. It's just that I trade them a lot. In fact, let's get right into that. Now, whereas I'm more of a singles hitter, Bill O'Neill is more of a home run hitter. He feels that the worst mistake you can make is to identify what turns out to be the big winner in a market cycle and mess it up and miss out on your opportunity to make big money. Now, Bill has kind of an uncanny ability to hone in on the leader in a cycle and really capitalize on it. And that is just a skill that takes a long time to get. And that's still something I'm working on in my own trading. I remember when we shared an office together, we were looking at a chart of a stock that had broken out and run up for about 4 or 5 weeks, and it was just sticking straight up in the air. And I said, I definitely sell that stock. It's definitely ready for a pullback. And he looked at it and said, I would buy more of that stock. This is your leader. This has the potential to go much higher. So there's more than one way to look at things. Now, he also said to me at that same time that if what you're doing works for you, don't change it. So at the end of the day, we're very practical. You know, our objective here is to make a lot of money in the stock market, even if the way you do it is a little bit different than the way he does it. Now, that said, and notwithstanding the success that I have had being a very active trader, I truly do believe that the really, really big money in the market is capitalizing on those big winners that come along every so often. If you can string together 2 or 3 big winners in a row and manage each properly, you can literally make a fortune in a short period of time and change your entire life. That's how Bill did it. Jesse Livermore did it that way. Nicholas Darvis, I mentioned during one of the breaks. The book is called How I Made $2 Million in the Stock Market. How many of you guys have read that? Okay, about half. Tremendous book. I actually have it upstairs. I brought it with me. It's one of those books, again, that you kind of reread. But it's not easy to do. It sounds a lot easier than it is. So I'm what you call a swing trader. I like to sell into strength when I believe a stock is put in kind of a short-term top and it's extended in price. And I like to buy it back on a pullback. And that might be a pullback to the 10-day moving average, the 50-day moving average. It might just be a percentage decline over a certain number of days that I've calculated is in the buying range. It could be a 3 weeks tight pattern. I'm looking to recover my position at a lower price. So I call it trading the trend. So this is what it looks like. I buy it down here at the pivot, sell it over here, buy it back on the pullback, sell it, buy it back down here. And you can see how simple it is. You just sell it when they ring the bell at the top, and you buy it back when they ring the bell at the bottom. We all know that there are no bells ringing off in the market except the opening and closing bells. The problem with swing trading is that while it looks really easy to do in hindsight, it's almost impossible to do really well in real time. More often, this is what it's going to look like. You are going to very often mess up the entire trade. I have a tendency to get excited and sell too early, and I also have a tendency to buy back too early. So I might sell some here, and I might sell some more here, and it keeps going up without me. And I'm thinking, I need to get the stock back. So when it starts falling, I buy it back, and then it starts falling even further, and then I get nervous. I made a mistake, I sell it, and you can just see how you are going to mess up the trade. Oftentimes, I will trade a stock that I really believe in. I think it really has the potential to be something special, but I'll sell it when it's extended, and I'll keep moving up, and I will never recover my position. So it's really difficult to be an active trader and really capitalize the way you'd want to. Jesse Livermore said, the big money is not in the individual fluctuations, but in the main movements. So I can't tell you how many times in the past I've had a meaningful position in a stock I believed had the potential to really make an enormous move, but my natural tendencies overcame me, and I took a 20 or 30 or 40% gain out of a stock that went up 200 or 300%. So it's important not to lose your conviction or your position in those stocks that you really think are something special. We talked earlier in the morning about if you don't have the conviction, then lock in your profit. But if it's something that you really have conviction in, whether for me like an Apple computer, you don't want to just sell it simply because it's up. You want to instead wait for the technical sell signals that we talked about. Livermore also said that men that can both be right and sit tight are uncommon. It's the big swing that makes the big money for you. So here you have Bill O'Neill and Jesse Livermore saying the big money is in the big swing. And then you've got me showing you how I've been successful trading a more active style. How should you do it? Well, the answer is going to depend on your stock picking skills. It's going to depend on your level of conviction in the stuff that you own. And it's going to depend a lot on your personality. So first of all, do you even have the skills to pick the big leaders? You don't know which ones those are going to be until after the fact. Take a look and see if you've managed to do that in the past. If you don't have the ability to pick those stocks with the potential to make the big moves, you're not going to be very successful just sitting and holding your stocks. Now that's where this workshop comes in. Hopefully, what you're learning through the technical analysis that we've been covering today, how to identify charts and bases that have the potential to be big winners. And you combine that with the fundamentals that you know about and the story and the new product, the N and CANSLIM, you put it all together, it's going to help you greatly in finding those big leaders. Secondly, how much conviction do you have in your stock? How well do you really know the companies you own? Do you have the stomach to sit through a stock that corrects 15, 20%, even 25%, and see a third or half or more of your gains wiped out? It's not easy to do that. Do you have the conviction to sit through a stock while it forms a base and see other stocks moving up without you? It's not easy to do that. I know that that's not my strength. So I play to my strengths when I trade. Some of you are built differently than me and maybe a little more like Bill or a little more like Mike, and you can kind of stick with those stocks that you really believe in through the ups and downs. If you have trouble holding your winners, like I do, one thing that Bill suggests you do is to create rules around your weaknesses. Mike mentioned the 8-week rule. If a stock goes up 20% or more in the first 3 weeks, you try to get through holding that stock for 8 weeks. No questions asked. You hold it for 8 weeks unless it comes back down and you're down on the stock. And you always have to cut your loss at 7 or 8%. But barring that, you try to sit for 8 weeks. That rule was created back in the early 60s when Bill bought a stock coming out of I think it was a high-tight flag pattern, and he bought a big position, it came off, he got scared out, and next thing you know, it tripled. So he came up with that rule to basically keep him in the stock, and so he wouldn't let his emotions rule him. One thing that I've started to do a lot more of is trade around a core position. This is basically my compromise because I want to be in there for the big moves and capitalize on the huge winners, and it's hard for me. So what I do now is, if it is a stock I have conviction in, I will keep a core position. That might be 50% of my position. And then I'll trade around the other 50% of it, swing trading, trying to actually maximize my potential even more. The risk is that if I mess it up, I'm not going to get the full potential of the move. Now, if I trade it well, I might actually do better this way. But worst case scenario, if I mess up the part I swing trade, at least I'm going to participate in a big leader. Now, another question that you have to ask yourself is, are you going to hold through bases along the way up? And I'm not talking about a pullback to the 50-day moving average or a 3 weeks tight or a flat base. I'm talking about those bases that actually test you, where you see the technical sell signals that I covered in the morning, and you're below the 50-day moving average and things look horrible, and yet you have a big cushion on the stock. It's still relatively early in the base count, and you have a much higher price objective. So everything is telling you the stock is going to be higher in the future, but in the medium term, you're suffering through a base. What do? Do you hold through that base or not? Only you can answer that question. I know myself. I'm not going to be able to hold through that base, typically. I'm going to be that guy who capitulates right at the bottom of the base. Okay? No matter how much conviction I seem to have, if my stock is off 30 or 35%, conviction goes out the window. I'm scared. I don't want to lose it all. And so I don't put myself in that situation. Or at least I try never to put myself in that situation. I have done it before successfully, and that was holding Apple in 2005. And I held through this space here. And it might not look so bad on this weekly chart, but it was a horrible experience. This stock gave you plenty of sell signals. You have your largest one-day drop. You have a weak rebound rally, another test of your 50-day moving average, and another weak rebound rally, and finally a decisive break below the 50-day. Okay, you've had 4 major sell signals. This was on an earnings announcement this day here. And I kept my position, I held it through this whole thing, and I'm sure it took a couple years off my life. I promised myself I would never do it again. Now, it worked out for me. The stock then went on and doubled over time. But there's another way I could have traded it and done probably even better. Had I sold it here, when I saw that all the technical sell signals go off, and bought it back here, I would have had 6 months or so, 4 or 5 months to play with some other stocks and deploy my capital elsewhere. There were plenty of other stocks that were working well while Apple was basing. Let's just go through some of them. They all have the same end date here. Google was on a massive tear. Broadcom was moving up. Hanson Natural, Chico's, Tenaris, Oil States. All of these stocks were having tremendous runs, and I was sitting in Apple, waiting. So if I had to do it again, I would say sell when you see the technical sell signals. If the stock comes back and builds a base, you can get back in, and you probably won't be too much worse off for it. That's how I play it. If you want to trade a little more like Bill has in the past, how he really capitalized and made his big money, he sat through bases. And you got to realize some of his stocks he held for years. Pick and Save he held for over 7 years. I have trouble holding for 7 days, let alone 7 years. So I couldn't do that. He did it, and he made thousands of % on the trade over that time. You have to ask yourself what category you fit in. There's more than one way to do it.
Like, if you're in a situation like that and you see all the related companies doing well, does that give you an assurance?
Stocks do move in groups. And so, like, let's say semiconductors are hot, they'll all seem to be working. The industry group effect is very important in a stock's move. So the answer is yes, but Google and Apple, I mean, those are technology companies, you could say, but they're not really doing the same thing. I would say, yeah, it gives me a little more confidence, but Apple wasn't trending up during this period. Apple was basing. That's different than trending up. If a stock pulls back and the group is strong, then I have confidence. Once you're in a basing situation, who knows what's going to happen? I mean, how do you handle this? I mean, you've got this enormous gap down on huge volume. You get this other gap down here. This is your shakeout. It just was another gap down here. I mean, it's not really the prettiest looking base. It was difficult. So, I had conviction in it. I knew the story. Honestly, I was also probably in a little state of denial, if I can be honest with myself. And it worked out. But that's not typically how I play it.
Just curious, using your more active style, what position sizes are you?
So the question was, given an active style, what are my position sizes? Pretty similar to Mike. Bill kind of holds us now to 30% or so max, because in the past we've kind of gotten carried away and taken on an enormous amount of risk. There was a time, too, I think Mike mentioned, when I would take on 50, 60% positions or bigger, and you almost get to feel like you have to take on that much risk to make the big money, and it's not true. You really don't have to. A normal position for me will be between 20 and 30%. Sometimes in my personal account a little bigger, but in general, you don't need more than a quarter of your capital or a third of your capital in any one position to make a lot of money. Okay, let's talk about earnings releases. What do you do during earnings season? It's really tough. Earnings season is a crapshoot. You never know what's going to happen. I don't know how well you know the company. You never know how the stock is going to react. You don't know what the earnings are going to be, first of all, and you don't know how the stock's going to react to those earnings. I've seen companies report huge numbers and gap down because guidance was bad. I've seen companies report horrible numbers and gap up because guidance was good. And I've seen everything in between. So the answer to how you're going to handle it is really going to depend on a number of different considerations. First of all, you have to go into the earnings realizing that anything can happen. What is your position size? Do you have a 30-year account in the stock and the stock gaps down? You're going to really feel that. So you want to be careful with how much you have. I remember back in the 2001 time frame, I was playing a bunch of stocks, and I was up enormous. I was up at several 100% on the stock, and I had 75% of my account in it. Went into an earnings release, down 30% instantly. So my account was down 25% off the top. I mean, it took a long time to recover from that. So I don't want to put myself in those situations anymore. How much cushion do you have in the stock? Now, if you're up big on the stock, you can afford to take more risk, right? If you're up 50% on it, they're probably not going to take it all away from you on one bad day. If, on the other hand, you're flat on the stock, you can be in big trouble. So people say, well, would you buy the stock 2 days before earnings? No, I wouldn't, at least not in any significant way, because you don't want to take the risk of really getting hurt on an announcement. Your account performance to date, if you're up big for the year, if you've made solid progress, again, you can take on more risk because you're in that mode. If you're trading well and you're up for the year, good things just have a tendency to happen in a sense. And when you're in a rut, bad things just continually tend to happen. It's funny how those trends occur. And the reason is because you trade differently when you're in a rut than you do when you're on a hot streak. When you're in a rut or you're down for the year, you question every trade. You have a tendency to hesitate at those pivotal moments in the trade, and you're not trading correctly. So if you are up big, sure, you can take on more risk during earnings season. But if you're not, if you're flat or even down for the year, you don't want to get further in a hole. Once you're in a hole, you trade defensively. To be successful in the market, you have to trade offensively. You have to trade to win, not trading not to lose. There's a big difference. What is the general health of the market? If you're in an uptrend in the general market, things typically have a tendency to work out a little bit better than if you're in a downtrend. That Apple trade I showed you before where it gapped down on earnings, the earnings were spectacular, amazing. One of the best reports I've ever read, but the market was starting to get in trouble, and so they took it down. And lastly, how are other stocks in the group behaving? Stocks act in groups, and they're affected by the same macro factors. So if you're in a semiconductor stock and they're all reporting good earnings, that's because there are macro factors occurring in the economy and in the world that are positively affecting all these companies. So chances are a lot of the companies are going to have those same benefits. So these are all the considerations that you have to kind of take into account. There's no right answer what to do, but maybe I'm just remembering it this way, but it seems to me that I have more stocks that blow up on me in earnings than ones that gap up. I don't know if this is how I remember it, but because of that, I try not to take on too much risk during earnings, and I usually cut my position going in. Will I sell all my position? No, I usually won't completely sell a position going into a release, but if I have 30% of my account in it, I might sell it down to 15%. That way I know if it goes up, I'm still going to have a great day. If it goes down, though, I'm not going to have to really rebuild. I like to always try to stay within striking distance of new highs, and I don't want to take a 10 or 15% drawdown on my account because I'm over-leveraged in one day. I don't want to take that hit. This, I was trading Apple back here, and while I sat through this in the firm, and it worked out fine, I had a tremendous number of options in the stock over here. And I had options all the way up. I was trading, and I was up several 100% in just a couple of months, 2-3 months. And I had full conviction that this stock was going to react great to the earnings release. And I remember I said to my wife, I had hundreds and hundreds of contracts. And I said, well, if it works out like I think, we're going to be in a completely different place. If it doesn't, I'm going to lose everything overnight to that, level. Basically, and she said, I said, well, what do you think? And she said, well, go for it. Well, I lost it all. I lost all my profit for the year in one day. So, she's still with you? Yeah, she's stuck around, but I blamed it on her. So anyway, let me just talk about a few very practical ways, kind of tools to keep you in a trade. Mike already talked about the 8-week rule, so I'm not going to repeat it, but 20% in 3 weeks, try to get through the first 8 weeks. The 10-day moving average is a very short-term moving average, the green line in your charts. It's going to hug the price action very closely. I have found that oftentimes the 10-day moving average will contain the initial advance out of a base. It's not going to contain the entire advance. It's way too tight and short-term for that. But if you have a tendency to sell too early, like way too early, like your stock breaks out and you're up for 5 days in a row and you say, I'm going to take my quick 15% profit. If you do that a lot, you're going to make a lot of money. There's nothing wrong with it. But oftentimes, the 10-day can slow you down a little bit and let you participate in a much bigger initial advance. Here are some examples on page 522. IGT. Now, IGT was a model book stock. It went up a huge amount over, I'm not sure how long the move was, probably a couple years, but it went up hundreds and hundreds of percent. And the initial breakout over here, the stock went up 70%, and it was contained by the 10-day all the way up. So whereas I might have had a tendency to sell it much earlier and lock in some profits, the 10-day would have slowed me down and allowed me to make a much greater profit in still a very short period of time. K-Swiss is another one, broke out of this cup with handle here, went up 126% before finally breaking down below the 10-day moving average. So again, that's an enormous gain in 7 weeks. And if you can just have the discipline to let the 10-day guide your action, it can help your trading out quite a bit. Lastly, titanium metals broke out and went up 53% in 6 weeks, all held by the 10-day moving average. Doesn't always work. But if you have that tendency where you're very jumpy, the 10-day will kind of slow me down and say, in fact, I even write it on my trading sheets. I'll write it on a sticky, put it on there and say, wait for the 10-day. Like I need to remind myself, don't get jumpy. The last one, question, yeah?
How do you use the 10-day with the 50-day when it's breaking down?
Okay, so the question was, how do I use the 10-day with the 50-day? So the 10-day here, I'm only using out of a consolidation or a base breakout. I'm not using it after the stock is way extended in price and way into the move. It's not as important. I'm really using it as a tool to keep me in an initial advance, kind of a new buy situation. The 50-day is a longer-term moving average, and it is going to also keep you in a stock for the big move. But this is kind of where you're in between the swing trading or the long-term hold. If you're not going to be an active trader, you can forget about the 10-day and use the 50-day. But if you're like me and you have that tendency to have trouble holding your winners, the 10-day can help you be a little more profitable and slow you down. I will often, if I've made a big advance in the initial run and it's coming down to the 10-day, I'll sell it and wait for it to consolidate. That might be one of my first sells. And only if it really conforms to this. I mean, if it goes up and 3 days later it breaks the 10-day, if it looked like a good breakout, I'm not going to necessarily sell it because it broke the 10-day. I mean, I couldn't even tell you what percentage of stocks hold the 10-day out of a breakout. But I've seen it often enough so that if it's very powerful, it'll keep me in that move. And the question is, do I get back in when it comes back over the 10-day? No, I've never really used the 10-day like that. I've only used it as really more of a supporting. I might buy it off the 10-day, but not necessarily coming back above the 10-day. There, I'd rather wait for the stock to come over a certain consolidation or resistance point. And then lastly, the 50-day moving average. Again, it's a very reliable tool. If you learn nothing else, if you take nothing else from the workshop, the 50-day moving average is a very strong, reliable indicator. And usually the first couple of pullbacks are buyable if you really have identified a leader. JDSU went up 2,000% without breaking that line decisively. And I guarantee you I never would have made 2,000% in that stock. But if that was your rule, if your rule was, I know what I have conviction, I'm going to wait for the 50-day to be decisively broken, this is what you can accomplish. USNA, now this is a stock I put in here because I traded it and I believed in it, and I bought it right out of this consolidation here. And you might not like how it looked. I liked it because of these shakeouts in here. These big blue spikes shaking out along the base, and it was tight. I bought it. I'm not even sure I made money on it. And this thing went up 600% in 36 weeks. It was thin. I got shaken out. I never got back in. And yet, I really thought I had found something. And if I just would have sat and let the 10-week moving average tell me when to sell, I could have completely changed my whole year. So it's a great tool to use.